Eva. Welcome to the show.
Thank you for having me.
So, if you could, why don't you give everybody a bit about your background? You're a Fulbright scholar out of Europe. You started your career as a financial auditor over at PwC in India. I also
Mhm.
spent a little bit of time at PwC, so we have that in common.
Great.
You worked across techs and startup companies. You got your MBA, and now your partner, Chief Operating Officer and Investment Strategist at ERShares. So, can you walk us through that impressive journey?
Yes, thank you for asking. It's not PwC India, I was in Europe, but so I had an undergrad in economics and business. And then I joined PwC right after my undergrad. I did not like it, although thanks to it, I can study companies now and analyze them, but I hated the job. I don't know about you. I did not like it. I don't know if it was because I finished my undergrad earlier than normal, at 3 years. I was the youngest at PwC, and all my friends were still studying, but it was very bureaucratic for me. And that's when I realized I want to be in innovation and entrepreneurship, companies that are less bureaucratic and they dream about the future and they build the future.
Yeah, I mean, I had a similar experience. Only I was on the tax side, and I knew after one tax season that I never wanted to be in tax again.
I was an auditor, so it was
Yeah,
like the least creative job you can have. So it was a no go for me. But that was very helpful because now it's everything you do in life, even the things that might not be of interest to you, it comes in handy in the future. So I'm very grateful for that.
so I ask everybody outside of work when you're not behind the desk, or you and I were just talking. You're going to be behind the camera this morning or later this afternoon. I should say. What do you like to do when you're not working?
Um, so my favorite thing in the world, if I could, that would be traveling. I love meeting new people and new cultures. I speak 4 languages. So that would be it, but I don't have that much time. So what I like to do is swim a lot. I was a competitive swimmer growing up. So swimming is the only time in my day that I have no distractions. So it's not just exercise. For me, it's like meditative. That's when I get my best ideas. I think about my work, also personal, anything. So this is the only time of day that I get to myself to think. So I would say this and spending time with friends and family.
Yeah, I love it. So let's talk about ERShares. The firm is founded by Dr. Joel Schulman with, I mean, more than 30 years of academic research behind it. Came out of Babson College in Hartford. For listeners who haven't come across ERShares before, can you give us like a high level of the firm and Joel's entrepreneur factor framework?
Yes. Joel was a professor and still is, but he's a tenured professor, but he does this part time just for $1 a year. But his whole research, he spent time and decades actually studying how VCs invest and how successful VCs invest and what makes a company what we call an entrepreneurial company successful long term. And so he studied this and then he wanted to apply this framework to the public markets. He brought what we call the VC lens. Because we study public markets like VCs, he brought the VC lens to the public market, and that's an extensive academic research where our model is based on. Uh, that has we have 18 attributes. Now we're adding a couple more that are both qualitative and quantitative. So because VCs study the team and how the founders and how the company is growing, the culture, there's a lot of qualitative characteristics that we analyze. We obviously convert them into numbers, but he came up with this proprietary model. We call it the VC lens, otherwise known as the entrepreneur factor, that has these 18 attributes. And this is how we screen all companies, public companies, but lately we added also the private sleeve to this.
Yeah, and so Joel was an early identifier of what became like the Mag 7, and that was a real credibility marker for him. What does the framework or this VC lens or the framework look for that gets you into these names before maybe consensus catches up?
Yes, I love this question. So, he was, to your point, he got into Nvidia in 2005 when it was a $5 stock. Back then, they were making chips for the cameras of the cars. So, and then he got into all Magnificent Seven or FANGs very early. So his whole model is to find these companies very early, like VCs do, because by the time they become household names, much of the value creation has already happened. So this is the beauty of being a VC in the private market, and this is the beauty that he wanted to bring that characteristic to the public market. So for people to be able to access these companies very early. Now, lately, and we'll speak about this, we added the private sleeve to this because we saw a change. We'll get back to this, a change in the market, how much of the value creation now happens before the IPO. So because we noticed that, our VC framework brought us back to where the thesis originated in the private market. That's who we study. We study VCs, we study how entrepreneurs become successful and which entrepreneurs become successful. And we wanted to bring that thesis to the public market for everyone to have access to these great opportunities.
Yeah, for sure. I definitely want to talk about that. But one of the things that's interesting to me that I want to go a little bit deeper on is that companies are staying private a lot longer than they used to, right?
Yes.
I mean, look at SpaceX, all the AI companies, a lot of the value is, you could argue has been created. Can you talk about that trend and what public investors are actually missing by only owning post IPO exposure?
Yes, I love the question, and it's the reason why we created XOVR, the crossover ETF. That's exactly the reason. So, over the last few years, not a few anymore, but you've seen a big shift in the market. We have this year is going to be a record year for IPOs, big names. So much of this value creation now happens before the companies go public. And that's a big shift. And retail investors in particular, if you're not an accredited investor, if you don't have over 1 million of investable income, like you cannot access this. And by the time they get to the market, it's already not late, but much of this value creation has already occurred. And because our whole model was to get into these companies early, and now we see that shift to the market. We're like, is there a way to make it more accessible to retail investors? And there is closed-end funds out there. There's interval funds out there. But in some cases, you need to be an accredited investor. There's high minimums. There's lockups. They don't trade at the near NAV. And so we realized that the current funds that are out there might not be the most efficient for a simple person who wants to invest $1,000, like $100. But we have investors in XOVR that might have like $50 in XOVR. So that's the beauty, that anyone can be part of these companies that were traditionally reserved only for institutional or accredited investors, and people were missing out.
Yeah, you touched on some of the highlights of XOVR there, which is the ERShares private public crossover ETF. This was kind of relaunched under the structure in August of 2024.
Mhm.
So, if you were to give kind of like your elevator pitch on what is XOVR and what problems does it solve for investors, could you do it?
Yes, of course. I love this. It is so it's an ETF. It has a 75 basis points management fee, which is kind of inexpensive for the work we do, because we don't charge more for all the private equity work we do, which is a lot of work. And so it trades like an ETF, but it provides access to both private and public companies. And we were the first to do it. XOVR was the first ever crossover ETF that allowed exposure to private companies. And people know us because of SpaceX. SpaceX was a great company to own, but that's not XOVR. XOVR is more than SpaceX. XOVR is supposed to allow retail investors to get access to these, what we deem category leaders, before they become accessible to the market, or before they become household names. So even our public companies, and we can mention some examples later, even these in some cases, and I have two examples that stand out, we got into them before they became household names and before a lot of appreciation happened. So we're trying to find the category leaders very early. That's what XOVR is. It brings you the VC lens. It's an ETF that follows a VC lens. So you get access to what we deem an entrepreneurial company, a company that will become a category leader in the future, like a Magnificent Seven. But we try to get into them very early.
So let's talk a little bit about the structure, right? XOVR is this private public crossover. Most of the portfolio is in, it's called the ER30 TR Public Equity Foundation, and there's a measured sleeve of select private company exposure in that. So how does that combination actually come together in one ETF without getting too nerdy on the legal side?
So 85% of the ETF class is following the ER30 TR index. That's the Entrepreneur 30 Total Return Index. And this is the result of what I mentioned earlier, the entrepreneur factor, or what a VC lens comes up with. So we take the universe of many companies, then we put that universe into that factor, which is automated, right? And I mentioned before, it's qualitative and quantitative characteristics. And then it screens them, and then it ranks them. It ranks them in based on how entrepreneurial they are, meaning how are they going to be a category leader? Do they have a competitive advantage? Are they growing with a high rate? How is their leadership? Is that a unique leader that's going to be Elon Musk, for example? So this is how this framework works. And so the result of this is the Entrepreneur 30 Total Return Index. And that has outperformed most indices over the last 2 decades. And so before that, before the relaunch, XOVR used to be called ENTR, and it followed not completely different, but a different methodology. And so we realized that the Entrepreneur 30 TR index was beating ENTR. And we said, okay, now we have to convert. We need to focus on the ER30 TR index and then add the private sleeve, because we saw that change in the market and get into these companies early. But that's about 15%. With SpaceX, we were able to exceed this because we had the liquidity arrangement, which was one of the innovations we made. But XOVR is 85% the index and 15% private companies.
So let's talk about some of the innovations that were made in XOVR and made it like very structurally different. So the crossover ETF format itself is something different. Private company exposure inside of an ETF wrapper is different. The 00 SPV structure is very different. The fund's liquidity arrangement and the shareholder protection plan, like these are very different from, I run a couple of ETFs. We don't even have to think about these things. So can you walk us through those and why each one matters?
Yes. So they didn't come from the beginning, by the way. So the first innovation was to come up with this structure, the crossover structure, private and public. And then initially, and we admit that, it wasn't the most efficient structure, right? So the innovations were a result of the problems we encountered. And again, we were the first ones. So this is uncharted waters. No one has ever done this before. We come out to the market and we're trying to figure out what's the most efficient way, right? So the first innovation was the ETF. The second innovation was that initially we were in an inefficient SPV that was charging a lot of fees, and it was not as transparent. So we converted that to a 00 SPV, which has no management and no carry, and it's very transparent. So you can reprice SpaceX for example, very easily. So that was the first innovation. Then we realized that people want more SpaceX, and we had the stronger conviction. And so we added to it. We exceeded the 15% SEC limit by creating a liquidity arrangement that let us exceed that 15% in a safe way. It was safe, it was board approved. So we were able to do that. And then the last innovation was the shareholder protection plan. And that was very important because in Q2, XOVR appreciated by about 27.5% in Q2, and much of that appreciation was because of the SpaceX position. And then in the month of and actually the SpaceX position is about now $370 million in the XOVR. And that was about 180 million of appreciation in Q2 alone for SpaceX. And then June, XOVR was up, I think, 5.5%, around 5%, when the S&P was down 2.7%. Again, much of this appreciation was, I think 75% of the appreciation was because of SpaceX. That provided about 85 million to XOVR. So the way we would have never done this before without the shareholder protection plan. And I can give you two examples. One is XOVR in January, where we had ARBs come in, and one, we had an inefficient SPV, and two, we had billions come in just before a repricing event. And SpaceX went to 2% of the ETF, so we lost. We got diluted, and that was the first time it happened to us, so we were not expecting it. And then with Cathie Wood's RKK, has happened many times during the year that 6 billion came in even on the day of the IPO and got all that appreciation. So we tried very hard to come up with a shareholder protection plan. We worked with our counsel and our providers to come up with an innovative way to make sure we give as much appreciation as we can to our long-term investors or retail investors, for example. And that's multiple steps in that shareholder plan. Number one, we repriced SpaceX multiple times. And our 00 SPV allowed us to do that multiple times in Q2. Number two, we said no to more than $1 billion of AUM flows that would have been obviously revenue for ERShares, but we prioritized the appreciation of the fund for the retail investors. So we closed our doors the week before the IPO, and people couldn't come in. And then we also applied a 2% redemption fee to big creation orders. And CUs, obviously, because you have your ETFs. So big orders from institutions that wanted to take that appreciation away from our long-term investors. And so that, first of all, made sure that fewer of them would want to come in. And also we had people sell because they didn't want to have this 2%. So we tried all these were super important for XOVR to have the appreciation it had in Q2.
Interesting. So one of the pieces you've touched on a couple of times, but I don't think I want advisors who are listening to this to realize the importance, is the 00 SPV piece, right? Mm-hmm. In traditional private market investing, investors face management fees and incentive fees in a private vehicle on top of the fund's own fees. So why did you guys decide to structure it differently and make it 00?
Okay, so for the SpaceX position specifically, that was the best way for us to structure it. The most transparent way. There was no extra fees. It was very transparent. But that doesn't mean that every time is the same, right? So it might be another purchase down the road where we see it makes no sense to have 00, and the upfront fees are higher than, let's say, 2 and 20. So that specific deal that we did, it made more sense to have a 00. It also allowed us to reprice multiple times, to have a transparent vehicle. But it's not like 100% rule, right? There might be cases in the future, and private equity people, that does not make that much sense. So it's also economic. So there's many factors you have to take into consideration.
So let's talk about Q2 specifically. XOVR returned 27.45% in Q2 of 2026, 5.3 in June alone. AUM grew from 400 to 2.2 billion during the quarter. It's a 5.5x increase. So let's just talk, what was it like inside the doors of the firm as all this was going on over the last quarter?
Unlike January, when we had 7 trades of ARBs come in and out, this time was very organic. So it was people who come in, and I speak with many people, many retail investors with small amounts who wanted to be part of this. Long-term people who see XOVR as a long-term hold, as something they want to have in their portfolio to allow them to get access to companies, private and public, very early. So it came naturally. So it was not sudden. It was something that this time we knew. We knew from historic data that we had with XOVR what works and what doesn't. And we saw the interest. A lot of people were interested in this for the long term because they saw that, we tried to help the retail. So our whole thesis and mission, I think, it shows that XOVR is not just, we're not prioritizing ERShares revenue. We always put retail investor first. And that will always be the mission of XOVR. And so I think many people understand this.
So we talked about the SpaceX trade maybe enough, but you've been very clear that XOVR is not just a SpaceX trade. Like, how do you talk about the fund's identity beyond, that one position that has kind of consumed, the media and everything over the last handful of months?
SpaceX was one of the companies that we have the strongest conviction in. So, and we believe this is going to be a long-term hold for XOVR. We're not selling. It's a very big percentage of the ETF. It's about 17 to 18% right now of XOVR is in SpaceX. And if that appreciates, that will get higher too. So we're not selling. We have long-term conviction. We think it's going to be the best Magnificent Seven. And we believe that before we made the purchase, the private purchase. So we had very strong conviction from the beginning. But XOVR is not just SpaceX, and it's definitely not a space ETF. We only have SpaceX and Rocket Lab right now in the ETF. It's more about this. So we're currently trying to find out what is the next category leader that we want to add, whether it's private. We're trying to get into all these category leaders very early. So it's a bigger thesis than SpaceX. SpaceX was a great case study, and there couldn't be a better company to launch XOVR with. So we are very happy. It works perfect. And I honestly believe SpaceX will be the leader when it comes to space. So it will be the category leader. That's exactly, XOVR is meant to find these companies like SpaceX very early.
Well, let's talk about kind of this, the AI space and everything that's going on right now. Maybe zoom out a little bit. Q2 showed us a lot about how companies are actually monetizing AI. You've been focused on revenue per employee as a signal for where AI is really improving business efficiency or not. So what's the data telling you right now?
So revenue per employee, and I mentioned before the framework that we use, the entrepreneur factor, is proprietary. But this is one extra statistic, for example, that we're looking at other than the 18 attributes. I think it's a very telling statistic because it shows you, and people have been saying like companies invest too much in AI. Where does all this money go? But if you look at this statistic, it's very telling. For example, Nvidia has about, I think, 5.5 million of revenue per employee. Now you compare this to the S&P 500 average, which is about 650,000 per employee. That's almost 10 times X. Another company that I really like, and we got into it very early before I joined the Nasdaq 100, before it became a household name, is Astera Labs. That's another company that, again, revenue per employee, it's 6 million per employee. So I think AI shows in some companies, there's many companies that speak about AI or they use AI, and you can't really see this in their financials. But in some cases, there are some companies that are doing a great job of, first of all, being part of for example, Astera Labs is a front end AI capture. So anytime a hyperscaler invests in AI, Astera Labs is one of the companies that gets benefited first. So it gets that money. So looking at these, I think I think Astera Labs will be a category leader, just like AppLove, another company we found very early. So I think AI is here, and if you look at their financials, it's easy to identify which company does a good job with it and which one doesn't.
Let's talk about just briefly a little bit more about the hyperscaler AI Capex, right? It's going from 410 billion in 2025 to be 700 to 750 billion in 2026. From your VC lens, where do you think the returns on all that spending are actually going to show up?
They don't show up in an index. So it's not that every AI company is benefiting. I think it's very selective. So we don't want to have an AI basket. We get into that AI basket immediately. No, you look at each company and how they benefit. Some of them is like a front end AI capture, like Astera Labs, that every time a hyperscaler invests, that benefits. Or AppLovin is a back end AI capture. The way they use AI, the way they grow their platform now globally, their action platform, the way they optimize their advertising is based on AI. So looking at these from a thematic point of view, thematic analysis, but also in the financials, like the revenue per employee that we mentioned before, I think can guide you into which company actually benefits from all this investment.
Well, I really, really appreciate you spending some time with me today. But before I let you go, where can people learn more about ERShares and XOVR?
So on our website, ERShares.com, we also are very active on social, X or LinkedIn, or even my personal Instagram. And, we try to have a lot of FAQs on the website. Every time people ask us something, we upload an FAQ. We send a lot of press releases, and definitely subscribe to our newsletter. We send about a newsletter every 2 weeks. So it's very informative.
Well, again, thanks so much for spending some time with me.
Thank you for having me, Brad.